Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. Today we're going to discuss third quarter earnings. We're in the midst of earnings season, as they like to say. Todd McGarity is going to join us to discuss some of those earnings reports that we've been hearing and also what the expectations are going into the fourth quarter. But before Todd joins us, I'd like to talk a little bit about where we are market-wise at this point in time. Today is Tuesday, October the 18th, and we still certainly have plenty of macro factors that are impacting our markets these days. We still have the European conundrum. Hopefully there will be some type of a solution or a plan that will be coming out of the EU shortly. In addition, we also have some concern over growth in China, whether or not growth in China is slowing. That's also having an impact on markets. And of course, domestically, we still have some policy overhang. Washington is Washington, and there are concerns as far as what type of fiscal policy might be coming down the pike and what kind of an impact that's going to have on corporate returns. And then in addition, there's still the mortgage overhang. We have had a few banks issue their third quarter earnings here recently, and there has been continued concern over mortgage defaults and what that's going to look like going into the fourth quarter. So there's certainly plenty of macro factors and a lot of headlines that are impacting our markets these days. Hopefully we'll be able to bring that into some kind of focus as we discuss what's been going on with the third quarter reports and also looking to the fourth quarter. So without further ado, please join us back here in just a few minutes. We're going to be joined by David Kroll first and then by Todd McGarity to discuss third quarter earnings.
Hello, this is David Kroll from Mortgage Network, and I'm here for the Mortgage Minute. My topic today is, when is it the right time to refinance? The old wives' tale is that you need to gain at least a percentage point on your mortgage to be able to afford to refinance. That is absolutely not true. There are some tricks to the trade that make it possible to make that advantageous, even if you're saving a 0.25% or 0.5% or 0.75%. And the trick involves having us pay your closing costs. If we pay your closing costs, or at least the majority of your closing costs, then the advantage is immediate to you of having a knockdown in your rate. If you're saving $100 a month on your mortgage payment and you haven't had to pay anybody anything to get the $100 a month, then obviously it's an advantage. So the bottom line is, don't count yourself out. These are the lowest rates in the last 50 or 60 years. It is worth a call to whoever you trust in the mortgage business to see if it is indeed cost advantageous to you. Thank you very much.
Welcome back to Money Matters. I'm Emily Johnson, and I'm joined today by Todd McGarity, Equity Portfolio Strategist at Polaris Capital Advisors. And today we want to talk with you about earnings. We are right now in the midst of what you would call earnings season, where companies are now reporting on their third quarter results and also perhaps giving some guidance as to what their performance will be in the fourth quarter. And as you might recall, and as probably some of your September statements are telling you, the third quarter was one of the worst quarters in history and on record. So a lot of these companies are going to be reporting on what has been, a rather tumultuous couple of months. So it's been a very interesting time. So I wanted Todd to come today to talk a little bit about the importance of earnings and also how companies might guide through difficult times, as we've seen over the last quarter, to better position themselves going into future quarters. So Todd, if you could talk a little bit about this. I know we've seen a real global slowdown just in the macro economy with what's going on in Europe, concerns over Washington, et cetera. So the third quarter was one of the worst on records. What is sort of the general theme as we go into earnings season in the fourth quarter?
Well, I think what you're going to find is this quarter, as you mentioned, was one of the worst quarters, and part of that was due to the anticipation that we were going to really have some poor earnings come out. I think it was telegraphed, that we were going to have, by most companies, that we're going to have some pretty poor earnings and
And
poor
didn't-
outlook.
I was going to say, didn't some of them actually come out and start guiding down sort of August time frame?
They did. Around the July-August timeframe, a lot of these companies found the economy really hit kind of a wall, and a little bit of a time correlation with what was going on in Washington, and also this situation in Europe, particularly in Greece, and the EU debt situation, of what they were going to do about the debt of some of these banks, European banks.
So
all
really
that
largely
culminated.
macro factors as
Right.
opposed to individual company factors. Okay.
And a lot of that culminated, in really the third quarter in kind of a strange slowdown, so to speak. Wasn't
And it really
horrible.
was
It
strange
just,
because we were going into the first quarter was very strong, second quarter somewhat flat, but really we just fell off a cliff. And if you look at pretty much any corporate chart, whether
Right.
it be a bank or an IBM, they fell off a cliff starting in August.
Well, not unlike 2008, there is a lot of investor worry out there. 2008 is still pretty fresh on our minds, and whenever you throw in something like the European situation and some situations in Washington, people were pretty frustrated with a high unemployment rate. And when you see a slowing in the economy, nobody wants to be the last one for the door, so to speak.
So let's talk about that for a second. I mean, basically, we've addressed these macro factors. We've talked about this, for several weeks. Unfortunately, we've been seeing it now for 8-10 weeks, I guess, on end.
Right.
So, when we're talking about these macro factors, obviously these companies are subject to that as well, whether it be through just headline risk and investor fear, or the fact that these macro factors are going to impact their bottom line. So how have these companies that are now reporting their earnings now in October, how have they sort of prepared the markets and prepared analysts for what we're hearing now this week and next week?
Well, this brings up an interesting point that we talk about a lot in the office.
I'm leading in a lot of ways.
What you're going to find is, in quarters like this where you start to have a slowdown, it filters through the market, and it filters through a lot of the news that you have, which really before companies even say anything, you start to see the market discount that worst case scenario.
The fear trade, basically, what you're saying is
right.
once there starts to be headlines that come out there that are pervading,
exactly
daily,
right.
then you start to see the market start to sell off, and it becomes a self-fulfilling prophecy.
Right. The market is a discounting mechanism, and will always look towards what is out there on the horizon.
Right.
And that's why optimism is so important, not only in our economy, but also in our markets. The markets are always looking forward. It's not really about what's happening today, and I know we've talked about this before, but even with the slowdown in the third quarter, some of the poor earnings, you're seeing some stocks rally on this.
Well, let's talk about that. So I know in the third quarter, as some companies actually looked at the macro factors that were going to be impacting their bottom line, they went ahead and took the step to guide their earnings, or to state that their earnings were probably going to be lower. They were guiding lower, say back in August, September timeframe. So now, and this is a question that I know we get a lot from clients, they'll say, well, why is it then that X, Y, and Z company just reported their earnings and they were horrendous, but the stock is going up, and then ABC company reported their earnings and they were excellent, and the value of the stock is plummeting.
Right.
So why is that happening?
Well, generally, what they need to do is go back 1 quarter or 3 months, look at the performance in the stock in the previous months before this horrendous earnings, as you call it, horrendous earnings announcement. Because generally,
just an example.
Because generally, what has happened before is the stock has already built that in based on the news that's available out there in the certain channels.
But I think it was also interesting, something that we've talked about is, these companies have guided down in part because they can use these macro trends, some of the negative aspects that are going on in the large economy, to then sort of, throw everything out there. I mean, like, for example, banks that have a lot of mortgage issues or any other write-downs that have to occur, they're able to just say, look, bad economy, things aren't so great, let's just, throw all the dirt in that we possibly can this earnings season. We'll guide down everybody else's too.
Well, any sort of loans, any sort of bad assets, you bring up banks, which is a great example right now.
Mortgages.
That's right. Any pending issues, they really throw in everything to the kitchen sink, so to speak, at this juncture. Because of the macro trends, it's easy to say, hey, let's go on and get it out on the table, because really, more we get out there right now, it's kind of everybody's in that same
sort
boat.
of, as a corollary, I mean, I suppose with, say, a personal bankruptcy, I mean, you don't sort of hold things back from a personal bankruptcy. It's bad, so you go ahead and throw it all out there so you can just clean it all up at one time. It's
the
sort of
same mentality,
right.
absolutely. When the focus is not really on them and it becomes a macro issue, it's easy to say, hey, let's use this quarter to mark to market on on this particular asset or this loan that's gone bad.
Right. So on a more positive note, I mean, as we're getting into, so now we've seen companies guide down. So now, as these earnings are being reported, they're not necessarily as bad as everybody expected in a lot of cases. And this is thus far, we're only 2 days into sort of a 2-week.
Right.
Well,
and a
cycle,
lot of the smart money out there, knows this factor of throwing in everything, on this type of earnings announcement. There's a lot of macro things going on right now, so a lot of companies, stocks have already discounted the worst case scenario. So you might as well go in and throw it in and guide down looking forward, because actually, that makes it an easier comparison and makes your stock appreciate, accordingly.
Yeah. So. Okay, well, actually, I guess we have to take a quick break here for a second, but we'll be back in just a second. We're going to talk a little bit more about these macro themes and expectations for the fourth quarter, as well as opportunities for value investing and what that means, and hopefully opportunities that we'll see with that in the fourth quarter. So without further ado, please join us back in just a few seconds. I'm Emily Johnson, and this is Money Matters. Welcome back to Money Matters. I'm Emily Johnson, again joined by Todd McGarity, Equity Portfolio Strategist at Polaris. And we have been talking about third quarter earnings and macro issues and what to expect going into the fourth quarter. So we just discussed a lot about what's been going on as far as the third quarter, the earnings reports that are coming out, and a lot of macro issues. Another big macro issue that we've talked about in the past is this twist. What the Fed has sort of enacted over the last few weeks, the idea of trying to keep the long end of the curve, keep interest rates at the long end of the curve 20, 30 years as low as possible. So I know sometimes when there's an action, there's always an equal and opposite reaction.
Exactly.
So talk to me a little bit about what some of the intended and unintended consequences have been of the twist.
Well, the economy, whenever the Fed intervenes in the economy, you got to think of it as Mother Nature. Whenever you mess with Mother Nature, there's always an unintended consequence on the other side.
Could be positive, could be negative.
Right, exactly. And I think what we're seeing now is a little bit of an unintended negative consequence that the Fed's trying to deal with right now.
Of trying to keep interest rates low.
Exactly. They're trying to keep interest rates low to stimulate, long-term purchases or capital investment
Even though rates were already low.
Exactly, but they're trying to keep them to a level that really entices investment on the long
long-term investment, right?
So they're trying to keep long-term rates really low.
Well, and that doesn't necessarily just mean, as I know a lot of people think, purchasing things. It might also mean throwing money back into equities, back into the market, so to speak, as opposed to keeping it in bonds.
They're forcing forcing money back into the capital markets that way, and thereby promoting investment overall.
So that's the goal,
right? That's the goal. The unintended consequence of that is, I'm sure, what a lot of our clients are feeling right now, that are living off fixed incomes, that are in their retirement years, and depend on that rate that they're getting paid off their investments. Right,
when they're used to getting 8% off of a relatively low risk or so-called risk-free investment, now suddenly it's 1.2.
Exactly. It's considerably lower on every fixed income instrument out there. And that's, you might say search for yield through other ways, utilities or something along those lines. We talked about those options. But for older people who are outside their earning years, those can be pretty dangerous choices, and that's a tough choice to make when you can't earn it back.
Right, and one interesting, I think, factor that we saw today, because we saw that mortgage foreclosures have actually been increasing, and there's some speculation that that might actually do the same thing. On the one hand, you might think, well, I might be able to keep my interest rate low on my mortgage. On the other hand, if I'm if I'm investing for fixed income because I live off of that income, there could be a negative consequence there.
That's exactly right. If if you've got a mortgage and you depend on income from your investments to pay your mortgage and to pay your to your living expenses, health care, so to speak, something's got to give at that point.
And suddenly that goes down.
That's exactly right. And I think that's why we've seen a leveling off of. We haven't really seen a pickup in delinquencies, but what we have seen is a leveling off where delinquencies were coming down. Bank of America has said in the third quarter that they've seen a leveling off, and that really coincides with the Fed's push of this twist program.
It's really interesting.
Twist program.
Yeah, because you wouldn't be thinking that that's where that second, or maybe we're on the third wave, perhaps now, of individuals that are concerned about covering their mortgage and that might be foreclosure candidates are having to make a business decision.
Well, it's one of those unintended consequences. You don't think about hurting that group, and a lot of people think it's hurting the housing market. Believe it or not, from the purchasing side, it's really hurting the ability, a lot of people's ability to use that income to pay mortgages. So a lot of those people who were probably okay, it was tight, but they were staying in their homes. Now you've got more homes on the market, and the last thing we need is more foreclosures and more short sales out there in an already distressed housing market. And that's a key to improving the economy going forward.
Well, we definitely also need to talk about some more positive aspects. Perhaps we can talk a little bit about just the value that we're seeing in the market right now. The third quarter, I think, really did create, hopefully, I mean, you could look at it different ways, but with the decline that we had, you really are seeing some great value in the market. And this is not just necessarily the pushing the buy, buy, buy button, but a lot of the macro factors really impacted impacted stock prices as opposed to the actual company fundamentals. So, you were saying earlier today in a conversation that we were having that you feel that now is a good time for so-called value investors. Define for me quickly what a value investor is, and then maybe we can talk a little bit about fundamentals.
Well, a value investor is what the term implies. It really is an investor that looks not necessarily at technicals, but looks more at fundamentals and looks more at pricing in relation to those fundamentals.
Technicals being historic price charts, fundamentals being more cash flows, balance sheets, et cetera.
Exactly. Okay. They pay particular attention to the multiples that they're paying. They like to buy stocks that they consider cheap on a relative basis to their fundamentals.
Okay.
Historically cheap prices.
And so why is now a good time to be looking at value stocks, and how would you identify value stocks?
Well, generally what creates that disparity between price and fundamentals is macro events like we've just gone through.
Headline risk, fear, people drawing their money out of the market for factors other than those related to the company's strength.
It's fear in the marketplace, and it's the Warren Buffett theme of buy when others are
when everybody else is running.
That's exactly right. So. When everybody else is running, he's buying, and uses fear to his advantage to get some good pricing out there. And he is a classic value investor.
So if you're looking at the fourth quarter now, and we've seen, I guess over the third quarter, there was actually a tremendous decline. It was approximately 20% or so, and I know we've seen some of that rebound back just in the first few weeks of October. But if you're looking into the fourth quarter, we still have this overhang now. We still have Europe. We still have policy issues in Washington. We still have concern over China's growth, et cetera, et cetera. It's definitely becoming much more of a global phenomena. So as you look into the fourth quarter, history would still tell us that based on the negativity and just the decline that we had in the third quarter, that we should be able to look forward to more positive returns this quarter, correct? Following on such a negative...
Exactly. I mean, history shows us that after one of the quarters that we've had, or the last quarter that we've had, if you go back in history and look at those quarters where we have double-digit type declines, generally the quarter following has always been a double-digit positive return.
So we had our 20% decline in August and September. Hopefully we have some positive to look forward to.
If history's a guide, then that definitely will be the case. So generally this is you can use that to your advantage for some significant outperformance for the next couple of quarters.
And do you typically suggest that people should look to buy if they're looking to say put some cash to work, or maybe looking to make changes in their portfolio? Do you suggest that they do that going into earnings, following earnings?
Well, one thing, and let's cover the value investing, because a lot of people, we get a lot of calls in the office of people trying to buy stocks that are really dropping like a rock. because they are big names, and it is it's enticing.
Right.
But one thing to
and
remember,
it's also, I think that it's reminiscent too of 2008, because people
Right.
saw banks at $2, $3.
and as the saying goes, just like 2008, you never want to try to catch a falling knife
Right.
at that point. You're never going to hit the bottom, the exact bottom, and you're much better off, and it's a safer play to wait till that stock bottoms out and shows us things like we saw today in a lot of the banking and investment banking
Healthy
names
balance
too.
sheets.
Healthy balance sheets,
Right.
and also when stocks react positively to bad news, that's something to look at. You know, what I tell people is pick a group that you're currently looking at, and look at some of the highest quality names in those groups, and wait till the stocks bottom out. Wait till they announce that bad news that everybody anticipates coming out, and see how the stock reacts. If it reacts positively on what would be normally considered negative news, that generally is a good sign that that stock or that particular sector is starting to bottom out.
Okay.
And that's what we've seen in some of the investment banks today.
So you might miss a little on the downside. I'm sorry,
Sure.
but you might also miss a little bit the downside and the upside, I guess.
You might miss the bottom price, but generally that's a much safer trend, because stocks can drop pretty significantly when you got the fear factor that we have out there now.
All right, well, here's hoping we have a strong fourth quarter. Thank you very much for
Absolutely.
joining us today.
Sure.
We'll be back in just a minute with the close of Money Matters. Welcome back to Money Matters. Just a few quick parting shots. Number one, of course, look at your portfolio to see what type of value opportunities might be there, and also consider repositioning your portfolio for tax planning here going into the fourth quarter. That's pretty much all we have as far as action items market-wise. Please take a look at our Facebook page. Please email us with any topics that you'd like to see us cover over the next several months. We really appreciate all of your ideas, and we try to incorporate them into our shows. Facebook page is, I believe, Money Matters / Polaris Capital Advisors, or email me at Emily at Polaris Capital Advisors with your ideas. Look forward to seeing you next week. This has been Money Matters, and I'm Emily Johnson.